The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Darrell Martin.
All right, folks, so come on back here to the Diagnostic Trading Hour. I'm your host right here on TFNN. My name is Darrell Martin, and I want to remind you can listen to all of the TFNN hosts on your mobile phone at tfnn.mobi, or you can watch them on your screen and actually see their charts at tfnn.com, watching Tiger TV right there. And, of course, in many radio stations across the country, various programs are broadcast as well where you can listen in on your radio. So right now we got the S&P, it's up 4 points. We got the Russell up 5.5. Nasdaq's currently up 2 points on the day. We got the Dow up 30. Everything just pretty flat right now. Looking over at copper, it is up about 1/3%, and gold is up about 0.5%, up 6 points right now. Silver is currently up about 0.5% as well. Natural gas up just a mere 1%. That's a small move on natural gas today. And looking over at oil, it's down about 40 cents right there. We got corn down just $1.50. We got soybeans up 7. That's a 0.5% up move on soybeans right there. Euro dollar is currently up 16 pips. Aussie dollar is down 43. Pound dollar is down $9. Franc is down 19. With the dollar CAD up 33, the dollar yen up 35. Aussie yen down 14. Euro yen down 14. And pound yen, Euro yen up. So, Aussie yen down 14. Euro yen is up 69. Pound yen is up 33. Euro pound up 22 pips on the day. All right, well, that gets us caught up just on our little market watch right there and where everything's sitting at the moment. Also, wanted to go through and do a couple reviews on a couple trades. We had some news trades last night. You always want to make sure you put the pieces together. One trader had me review a trade for him, and so I'm not going to call out the trader, but I want to show you sort of what they went through and the steps that they could have done to have helped themselves out on the trade to make it a little more effective, okay? So, on this trade, this was from the pound-dollar trade from last night. Okay, so right over here. And we had the retail sells that came out at 4:30. You can tell where the retail sells came out. Also, I could pull up a separate chart and maybe get a little more information. So let's hop over here. It's the pound-dollar. And we'll break down to just a few minutes, but we had a pretty decent move on the trade, but it was the high to low thing. So let's check out now. That's what our main measurement is, but we're still going over here and we throw it on, and right here measure from this low up to this high. We got 78 pips. That's what we expected. We expected a high to low of 78 pips. Okay? Often the market will start trending in a direction. And so that's why we try to get it early, because it'll trend, like in this case, it trended down, down, down. Okay? Before the news. And if it kept going down, then you would have, often you miss it because it only moved down like 30 or 40. In this case, it actually pulled right back up to the exact same high. Okay? To the exact same high right there. Pulled right back up to it before turning back around. If I throw deviations on here, then what you'll see, about a half a deviation move. And if I look at, the low to the high on the deviations, and go over here, and so I can see almost past a one deviation retracement there, but not quite. So really just not a massive move, but still within the expectation of 70 pips. So on this trade, though, one of the important pieces was to get in a little bit earlier, simply because often on the pound, it'll chop and then it'll trend in one direction and then take off. So one of the things I said is, hey, if we're going to be in this trade, you want to be in this trade by midnight, okay? And you're looking at the 7 a.m. expiration. You need to set your take profits. So first, let's just see, how far did it move? We'll just call it right from midnight to make it easy. So, right over here at midnight, what do we get just to the downside? Okay? We only got 37 pips. What do we get to the upside over here? Okay? Well, 7 o'clock, the highest price right there, about 40 pips. So that pretty much, 77, 78 adds up to our range, okay, that we got. So we got 40 down, 37. We really were looking for, a lot more than that for it to be a great trade. So is there anything you could have done? If this would have been a set and forget, put it on, go to sleep, see how it works out, okay, which the majority of the ones have worked. But how would that have worked out on this? So what could we have done? Well, one of the traders sent over the trade. They're like, is there anything I did wrong on the trade? And so I put in, okay, the average, high to low, we're looking for about 70 pips. The straddled floor and ceiling, they bought a 66.50 floor and sold a 66.50 ceiling. They bought it at 66.71 on the pound, and they sold the lower one at 66.32. And the pound was sitting pretty much right at the money, right at 66.52 when they got in the trade. So that was a good trade right there. And so putting all those pieces together, and the risk on the trade was $39. So, they got it lined up. It was right at the money. Risk, definitely seems acceptable. The last piece you have to look at, and this is the piece that I keep going over because a lot of people miss it, is you have to look at how far it has to move, how far it, meaning the market itself, has to move for you to be able to be profitable on the trade. And so I looked at that and I'm like, okay, well, $39. All right, so I'm going to need to make $39 plus 18. Okay, because let's say the market shoots up, I need to make $39 plus 18 to be profitable on the trade, because I got to assume the short side is going to lose. So that's where, $57 is how many spread ticks I need in profit. And then on the short side, I need to make $39 plus 21, because I got to assume the long side is going to lose. So I need to make 60 ticks in profit. And here is where the mistake happens. People look at this and they go, oh, it just has to move up 60 or down 57. I expect it to move 70, so that will work. That's incorrect. That's an incorrect conclusion. May work, but that is not the actual correct conclusion. That's how far you need to get out of the spread, okay? That's how far the spread has to move. Well, what is it going to take for the spread to move that far? Well, it's easy. It's not like binaries. It's very simple. But the underlying is going to have to at least move that far. Okay? So what does that mean? Well, if I added 57 ticks, okay, to where I bought here at 66.71. If I add 57 ticks to that, then that means I'd have to sell out of the trade, okay, at 67.28. Well, how far is 67.28 from where the market's at 66.52? Well, 76 pips. Okay, so that's actually requiring, now, again, I'm not expecting more than 70, period. Okay, I may only get that's an average of 70. So I might get 80, I might get 60. Okay, so we're literally pushing past the average. We're saying this is going to be an above average trade. The market's going to have to move 76 pips up for me to be able to profit on the trade, because where I'm going to take profit, my 57 pips I need to take profit needs to be 57 pips higher than where I bought it. And in reality, we probably need to add in 4 ticks. The bid-ask spread, it's anywhere between 2 and 4. Usually it's about 2 to 3 on euro dollar. So, really we're talking about 78, 79, maybe 80 ticks at the widest. That it's going to have to move, and I only expect 70. So it's not in my range. Okay? If it does hit that, and again, not accounting for bid-ask spread or anything with it, then I'd make 85% risk-reward, which sounds good, but again, that's losing 100, making 85. Okay? Now that's taking it off if I took it off at the 70 pip expected move of 67.22. Now, on the short side, I got to make my $60. That means I gotta buy back 60 pips lower than where I sold it. I sold it at 66.32. I got to buy it back at 60 pips lower. I got to buy it back at 65.72. Well, what is 65.72 from where the market's at? The market's at 66.52 and I have to go down to 65.72. That's an 80 pip move. I only expect 70. So I'm saying to make my 1-to-1 a set and forget, it's not within the range. So I either need to wait and see if some premium comes out, or not do the trade, or check the trade later, or whatever. But that's the range. That's the move I expected. It's not within that range. What if I took it at the 70 tick? Like, again, not accounting for bid-ask spread. What if I took it right at the expected move? I'd make a 74% return on my trade, which is a 3-to-4 reward to risk ratio, right? 75% return. So we can go over here, we can look at it and go, okay, well, what was our high that we actually hit? We hit a high of 66.88, and we were going for 67.22. Obviously, we didn't get anywhere near that. We hit a low over here of 66.10. We were going for 65.82. We also didn't get that. So in either case, we did not get our expected move, nor did we get, obviously, the over-expected move. But just simply knowing that this trade is outside of the range, I'm just not going to do the trade. Okay? Now, the other possibilities, I could flip it, and I could do an iron condor. That would have been very profitable. And that's where I would have went in, and I basically would have just did the exact opposite trade. I would have bought this lower spread down here, right down here, and I would have sold the spread up here. And I mean, it came right back down. You would have almost got max profit on that trade. You'd be really, really close to max profit on it. And again, that's just doing the exact opposite because the premium was too high. Wasn't within what I was comfortable with. So I can always look at potentially reversing it. But I mean, we got in here, and you go over, well, what was the close? I mean, you're talking 10 ticks. So out of the $39 you brought in, you got to keep $29. So not bad at all. But iron condors are pretty sweet trades, and the premium's too high. And pound dollar, sometimes that's actually most of them I do them on is pound dollar. Now I'll usually do them on FOMC, pound dollar interest rates, NFP. A lot of times that's when I see those pound dollars being so inflated, and I'll go and I'll do iron condors on those trades. Okay, so basically the best way to limit your risk and avoid risk is to not take a bad trade. And based on the numbers given, that wasn't a strangle or straddle that should have been taken. All right, stay there. We'll be right back after this break.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, welcome on back here to the Diagnostic Trading Hour. We're going to call in Tim from Virginia. Are you there?
I'm here. Can you hear me?
Yeah. My daughter, she was born up in Virginia, up in Northern Virginia.
Oh, all right. Yeah, that's where I'm living, and I used to live in East Texas, so it's a small world, I guess.
I like where I'm at now. We were up there. She was born in Fairfax Hospital, right there on the belt.
Gotcha. Yeah, I had a question. I really do appreciate you going over these news trades on the show. It's very informative. I had a almost identical trade put on. And based on some of your previous radio shows, I knew that the 70 pips for the one-to-one take profit was kind of out of range.
Right.
And after hearing what you just went over, and what I did last night was I set a 50% take profit, just thinking, I know it's out of range. Let me give 50% a shot. I'm not going to stay up and watch this thing at 4:30 in the morning. So. Okay. Because of what you kind of went over and how the one-to-one was out of range, would it be safer just to say, I'm going to stay away from it altogether, even though I was targeting the 50%? Maybe this is like algebra, maybe it's too hard to answer that question, but...
what I would say is if it's out of the range and you're not going to be there to manage it, don't take it.
Right, okay.
I had a trade the other day I did on the Aussie. And my range I could hit on the upside, but I only had like 8 ticks on the downside. Like, basically, that's all I was going to make. And so I put the trade on, and I actually put my 1-to-1 on the long side and the short side.
Right.
But I was watching the trade. And so, I mean, I gave I basically said I got about 15 minutes. If I don't hit the downside, I'm changing my take profit up to like break even. Okay? And so I was ready to get, because, I mean, average of 70 couldn't mean 100. You know, I mean, it could also mean 30. You know, so just, you never know where it's going to fall in that average. And so the 1-to-1, now, since one of the sides looked good, I was willing to take the trade. The other side, I'm like, hey, it could break out and go down further. And actually, it did. I made money on the short side. It went down, and I made 100% return on the short side. But I was ready to manage that trade and go, you know what, if this thing isn't moving in my direction, isn't moving fast enough, I'm going to hop out of the trade. Because, if we look at that pound-dollar trade from last night, if you weren't managing it and you took on the trade whenever there really just wasn't the expected move, you came down here, the market flew down, flew right back up, and you probably could have got out. If you're doing the same trade, the risk on the trade was about $40.
Right.
So you probably could have got out right around break even, because we moved up and down about, almost 40 pips.
Gotcha.
So, meaning you should have been able to get back most of your profit on one side or the other. Seeing it, like, if it flew down 40 and that 40, like, right at this point right here, like, you don't know, like, when it first comes out, but whenever it moves up, and see that high to low, how that was 78 pips?
Yeah. Mm-hmm.
So once I've made that move, I'm belling, because if you held on, you pretty much got demolished on the trade. You came back and you got like $10 back out of the 30 or 40 that you risked.
Right.
So, which is probably, if you put the trade on and you put even a 0.5 to 1, you probably didn't. I'm guessing you didn't get hit on your 0.5 because it had to still move about 60.
Exactly.
Pips. And so if you think about even 60 pips, you're still pushing the average, but yeah, 60 pips. You're right there. You're just 10 ticks away from the goal, just to make 0.5. But I won't say I won't push it. I'll just say I won't push it if I'm not going to watch it.
Gotcha. That makes a whole lot of sense. I follow you. I've got a second kind of question, and I haven't really gotten my head around the flip side of this. I think you call it the iron condor, but it seems like it seems like that's a riskier type trade. Even though I know I've seen you work it out, is it? Do I just have it backwards in my head?
It's not really that. It's not really riskier. No. It at first glance it looks riskier. Okay. But it's going to be. It may be riskier than a straddle. Depends on how much the premium is and how wide the straddle is. Okay. But if you go over and you pull it up, and let's say you have a 100 pip wide straddle. Okay, 100 pip spread on the upper side, 100 pip on the lower side. And sometimes, they're literally charging like 40 pips on both sides. Or 30. Okay. Let's just say they're charging, not even that much. Let's just say they're charging, stay right there. We'll talk about it when we get back. Okay? I'll walk through it with you.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com. Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, come on back here to the Diagnostic Trading Hour. And I got Tim on the line from Virginia. We're going in, we're talking about straddles. And, basically don't go in and force the trade if you're not going to be able there to watch it. If you don't go in and take it if it's too tight. And then the next thing we're catching up on now is iron condors. Are they a lot riskier or not? So you there, Tim?
I'm still here. Yep.
Awesome. Okay. So, it depends upon how wide the straddle is and everything else. But what you got to do is you got to look at your realistic expectation. Okay? So let's say I have a straddle. I'm just open something up over here, and I'll zoom in. All right, so we'll say it's 150 ticks up and 150 ticks down. Okay, so like that would be a normal straddle, right? So on a pound dollar, like for a 7 a.m., they're 150 ticks wide. Okay.
Okay.
And my expected movement up or down is 70 ticks. So I'm thinking like a positive 70 or a negative 70. That's really the most I expect to happen on almost any given news trade on the pound anyway. Okay?
Okay.
So let's say I go in and I can receive, depends on the news. This one would probably be a little bit pushing it, but let's go ahead. We can go with these numbers. Let's say I got 20 on the buy side and 20 on the sell side. Okay?
Okay.
That's about the risk that was on this straddle trade from last night. And so I go, okay, so 20 and 20. And so this right here, if this, and we're going to assume this means we're 20 pips above the market. Because that's pretty much what you were last night on that trade, right?
Exactly.
So about 20 pips above the market. So that's like line 0 right there. And then this is, 20 pips below the market, okay, for the price on the trade. So now what you got to look at is go, okay, well, if I sold this, which is opposite of what you'd think of doing, and I bought this, where do I break even? Okay? So if I sold this contract and I got $20 for it, then the market would have to move up 20 pips for me to be break even on that contract, right? Like, I mean, if it stayed down, I'd make 20 pips because I can make from the where I sell down to the floor. Does that make sense?
Yeah,
sort of. It's okay to say no. Yeah. Like right here, let's say if I like this. Let's just say this was the spread that I sold. Okay. And let's say I sold it right up. Let's say that we're at 66.50, okay? So let's say I sold at 66.70, okay?
Okay.
And now it's a little bit wider. I mean, we'd have to, bring it up here or whatever to make it 150 pips. But I can make, if I sell, I can make money from here down to the floor, right? My risk would be from here like up to the ceiling on a spread.
Okay.
Does that make sense?
Slowly.
Okay, well, if you're buying it, well, let's just put it in reverse. Let's put it what you're used to doing, okay? If you're buying the trade, and if I bought it at 20 pips above, it'd have to move up 20 pips for me to be, like, I could lose $20, up to $20 if it didn't move up at least 20 pips, right? If the market was right here, and it stayed here, I'd lose $20, right? If I bought a spread and there's 20 pips of premium in it, I'll lose $20 if it doesn't at least move, if it just stays flat or moves down. That make sense?
It does.
Okay, so if we move up, 20 ticks, then we'd be break even. We hadn't made anything on the bot spread, but we've at least got our money back, okay? Right?
Yep.
If it keeps moving up, we start making money, right?
Right.
Okay. But, down here, anywhere between, this area down, we're losing up to $20 on the trade. Right?
I'm with you.
Okay, so we're going to do the opposite. So every arrow is going to change direction. Okay? So we're going to sell instead of buy. If we bought, we'd get it to break even once we were up here. And then we'd make money above it. And we'd lose a little bit if we're below it, and we'd lose max down at the floor if we bought it. But if we sold it, we'd max out on our profit at the floor. Okay?
Yes. Mm-hmm.
And we'd lose money starting when the price got above the price we sold it at. So it's no different than when I sell this contract right here and the market moves up, I'm also going to lose money on it. Like if I sold both of them, if I sold the upper one and I sold the lower one, right? I'd make money on the way down and I'd lose money on the way up, right? Doesn't matter what spread. It doesn't matter if it's only 20 ticks of risk or 80 ticks of risk. Either way, I make money if it goes down and I lose money if it goes up. Right?
Right.
So that's the one thing, like, don't worry about where you're at in the spread. It doesn't matter. The reality is you make money if it drops, you lose if it goes up. Okay? Now, your risk obviously is a lot greater by selling the upper spread. Or at least it appears that it's a lot greater. Okay?
I agree.
So one thing to look at on here is to go, okay, wait a minute. I'm right here, so I have all this distance. This is pure premium right here. Because I'm selling it 20 ticks above where the market is right now. I mean, if you can sell higher, 20 ticks above the market right now, that's premium. Okay? So if it stays flat, I make 20 ticks. If it goes down, I make 20 ticks. If it goes up 10 ticks, I still make 10 ticks. If it goes up 20 ticks, I break even. Okay?
So what if it goes up 30 ticks, the other side is helping cover that loss?
Exactly. There you go. Yep. So if it goes up like 20 ticks, I'm at 0. Okay, let's just say the price moved up 20 ticks over here. And then I got a 20 tick profit on this side. So I could actually, if it's up that far, I'm going to make all 20 ticks on my bot side. So like right here, and that's where the risk actually isn't as big as it seems. Okay? So, because right here I'll make money max up to, like basically all the way, infinitely up. Okay, I'll make my max 20 tick profit. Here infinitely down, because on that one that I bought below it, I'll make max profit, which is only 20 ticks, but I'll make it no matter how far down it goes. So now that we know that, it's like, okay, well, it could move up 20, and I'd be down, 0 on the first one, and I'd be up 20 on the second one. Right? Because if I got $20 in premium on my bought one, and I got $20 premium on my sold one, well, if it's moved up 20 pips from where the market was, if it's went from here up to here, then now I have hit my break-even point. So I'm no longer making anything. I'm at 0, but I've made 20 pips from this trade. So I'm up 20 from the one that I bought that was below the market. So if the market got up to, let's say, 20 pips higher, then this trade has made it 20 pips. This trade has broke even. So I'm actually up $20. Now let's say it moves up 40 pips.
Yeah.
Now I'm down 20 on this one, but I'm still up 20 on this one. Okay? Now I'm at break even on a 40 pip up move on my total trade combined. Okay?
Okay.
And this isn't like an iron butterfly with butterflies. It's not an all or nothing. That's one of the reasons I like them so much. Okay? So now what if it moves up, 60? Okay? Well, now I'm down 40 on this one. I'm up 20 on this one. So at this point, I'm netting, $20 or a $20 loss, right? Go over here and then just take the little formula and move it on up. So let me grab that and I'll drag it up there. Okay, so I just started netting a $20 loss. Now I go up here and let's say it goes up 60 ticks. And then I make 20. Now I'm down $40. What if it goes up the 70 tick expected move? Okay? Now, remember, expected move really means that's the maximum move we expect. We expect it to pull back after that. Okay?
Okay.
So I still made my 20. What if it goes up, minus 80? Like this one, it went, like we had 78 pips high to low. I mean, even though it didn't move the whole 70. High, from, where we were at. I'm still up 20. Okay? And, you can do the exact same thing on the other side. Well, what if it expired right here and I made 20? Now, this would have to be right in the center, which you don't really expect. I expect it to be off by probably 5 or 10 ticks, okay? Because I expect it to pull back up and come back. Well, I'd make $40 if that thing expired right in the center because I'd make 20 here and 20 here. Like, if the market came back and it would have expired right back where we got in at, you make $20 on both sides because you make $20 on the one you bought because you bought at $20 below the market. You'd make $20 on the one you sold because you sold at $20 below the market, so you'd make $40 on the trade. Now, it actually expired 10 ticks higher, so our net result was we only made 10 on the one we sold. We made 10 on the one that sold and 20 on the one we bought. So we netted a $30 profit. But we had a maximum $40 profit potential on the trade. And it would have had to move 60 pips for us to have a 1-to-1 risk-reward ratio. Okay? For us to lose $40. If it moves 70 pips, Okay, now we could lose 50 on a maximum 40 profit. If it moves 80 pips, now we could lose 60 on a maximum $40 loss, which really is pretty much what you were doing anyway on the straddle, right? You were putting up 40 to make like 20?
Right.
So you're pretty much doing that risk-reward ratio, but you had to have movement.
Okay, so if
See, I could do the same reward-risk ratio, but not have to have movement. That's a better trade.
Well, what if it does something unexpected, like goes to the top of the box? I mean, and granted, that's unexpected. We don't plan for that, but
yeah, there's been once or twice this year where it's actually went like 120 pips. Yeah.
So would you be looking? Because at that point, you did lose more than the plain straddle where it was $38 total. You know, you
That's
lost
right.
At that point, you're going to be like 120. But so then you maybe start thinking maybe I should get out or let it retrace. I guess that's up to the trader at that point. Would that be?
Yeah. There's basically two ways to do that. One is you could use like the stop trigger function that we have now, and you could set it at sort of like, you know, maybe your maximum pain threshold. Like,
gotcha.
you know, you could say, you know what, at minus 100 and plus 20 over here, like, I'm going to bail out of both sides of the trade. Yeah, I'm down. I mean, that's 2-1, but at this point, I'm wrong. You know what I'm saying?
Okay.
So that's a possibility. Another thing that you could do, and I have looked at now this, I'm not even highly recommending this. I'm just playing with the idea. You know, I'm always looking at different ways to trade it. Is you could look and go, how cheap can I get that binary? And you could throw that on as a hedge, like, you know, before the trade for maybe like $5 or $3
Look
on
for
each side.
Binary at the max pain point, and then
Yeah. And then that way, if it expires above it, well then, hey, you know, if it gets, I mean, you can even tell it to take off your profit, or you can close everything at once, and you may come out like break even on the trade. You know, if you bought the thing for $3, you ended up, and you sold another one for $97, so you had $6 risk. You took the thing off at $40. You know, you may only be down $10 or $20 on the trade if it actually does hit that point, but you didn't give up too much of your profit in the process. So that's another way to hedge it off. So either you could use a stop ticket, you could do a binary really out of the money strangle further than expected. That's like stupid cheap with a take profit put in. You know, and then the other one is, I mean, there is the reality that it does happen, but it helps more when you go back and look at, I mean, I've looked at every single chart on every single announcement. But it doesn't just it pulls back. You know, I mean, the market, even on big move days, I mean, it pulls back.
Right, kind of like the CAD did today, like you were saying.
Yeah, so it pulled back, it went up there, it did that. I don't know where it's going to end up at, but, I mean, we already got in, we took our profit, it ran up, and done. I mean, as long as you got in at 10. But let's see, where's that trade at right now? Yeah, see, now it's pulling on back down. But it usually, like this is pretty rare, so we'll see what happens by 3. But normally, this trade would actually expire above 1127, and it still may. I mean, we only got, we got a few, 9 ticks left on the trade. But so the condors make a little more sense now.
It makes a lot more sense, Darrell. I felt like before it was, short and Google, but now I see it's still defined risk, and that helps a whole lot. Thank you very much.
Awesome, you bet. Thanks for calling in. All right, we got Mike right after this break. Stay right there.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
Welcome on back here to the Diagnostic Trading Hour with yours, Darrell Martin, and we got Mike calling in on the line from Dallas. What's going on, Mike?
Hey, Darrell, how are you doing?
I'm doing great.
Just a quick question. I understand what your philosophy is in taking profits and expected moves and so forth, 1-to-1 ratios. But when
now that's on news trades, but yeah,
right. But when do you realize that you're wrong? And do you is this a philosophy? I know that what I put into it is my stop, but I may not want to lose it all and wait for the market to change. So, what do you use 50% of what you? I just want to know if you have a general rule.
You got to give me context on the trade for I can answer your question.
Well,
because obviously saying I'm not wrong isn't going to help you, but
I know.
Do you mean like a news trade, or do you mean
just a trend trade? A trend trade, basically.
Well, on a trend trade, I look at the trend line. So on a trend trade, I'm not 1-to-1 on trend trades. I'd grab the crap out of profits. I made 900% on a trade Friday. I don't limit. I mean, I let my profits run, and I protect my profits. You don't really cut your losses short so much because Nadex sort of does that for you. But the way you cut your losses short on Nadex is you just limit your position size.
Oh, okay.
So I mean, if I'm comfortable with $100 risk on a trade, that's okay. Well, there's $30 risk on this. I can do 3 of them. Now I'm going to trail my stops, and I mean, I trail my stops.
Okay.
So that's really how I go after a trend. Now on a news trade, it's a little bit different. That one I'm going to look at expected moves, deviations. Like on the pound dollar. Let's say you did put this trade on last night that we were talking about.
I did.
You're watching it.
Yeah.
If you were watching it, when you saw it move that 70 pip high to low,
yes,
it's time to be out.
Okay. Well, I made some money on it on going up last night. So
sweet. Good.
Yeah, a little bit. But anyway, okay. Well, thank you so much, and I sure appreciate your show.
Yeah, and if you ever have a specific trade you want me to just pull up on a chart and say, hey, this is a trade I did. Where would you have gotten out? I'll let you know. Or where would you get out? I'll be glad to pull up specifically any chart, any instrument on the planet, and go through it with you.
Very good. Thank you so much, Darrell.
Hey, you bet.
Have a good one.
No problem. All right, so let's check out where all the markets are at right now. We still got the indices just hanging out, doing a whole lot of nothing. Just bouncing off settlement over and over and over again. Statistically, we usually do actually have a short on the S&P as of 11 o'clock to 4:15. So 77% of the time, seasonally adjusted, the market should close lower. So the price was at 11 a.m. on the S&P today. So we'll see if that seasonal adjustment stays the same. Right now, looking like a sort of a short. You could say a short trend, but I mean, I'm not. I mean, it's flat. It's not doing anything. It's just chop. Pretty much the same on most of the indices. And we can look at a couple of them real quick. And let's see here. Let's check out the Russell. See what we got on that. We can all go over and pull up the Dow and maybe the FTSE. But anyway, it shows about the wrap up, I know, right here at the end of the day. But I just want to get you caught up. We got the S&Ps up 3, got the Russells up 6. And look over, gold looks like it closed on up about 9 points on the day. Not too bad. Oil down only 22 cents on the day. Eurodollar is up 20 pips and pretty flat markets overall. So I hope you have a great weekend, and I will see you Monday. Stay tuned. Another great show coming up for you right after this.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
You're watching Tiger TV.